Many investors think of dividend-paying companies as a slow, low-return opportunity. Well, let us tell you that these investors could not be more wrong. Hello everyone and welcome to our channel today. We're going to tell you guys all about the power of dividend investing and how this is a sure-shot way of becoming a millionaire. So let's go and begin the video. First, let us discuss what we mean by dividend. Dividends are payments made by a firm to its investors to share earnings. They're paid on a regular basis, and they're one of the ways that stock investors might profit from their investments. But remember that not all stocks pay dividends, and even if they do, the conditions might not be so favorable for you. Understanding how to evaluate dividend-paying firms will help us see how dividends can help us increase our returns. A high dividend yield, which indicates that the dividend pays a relatively high percentage return on the stock price, is commonly thought to be the most critical metric. However, a yield that is significantly higher than that of other stocks in an industry may indicate a depressed price rather than a good dividend. As a result of the falling stock price, a dividend cut, or worse still, the abolition of the dividend might be on the cards. The essential indicator of a dividend power is not a high dividend yield, but rather a high business quality, which you can learn about by looking at its dividend history, which should grow over time. Looking for such firms may be quite beneficial if you are a long-term investor. Now that you have an idea about dividends and what to look out for in the companies that give them out, let us move to the part where we tell you about the true power of dividend investing and the snowball effect. Dividend growth investing, DGI, is a popular approach to generating wealth for a variety of reasons. It has a tremendous compounding impact and, if done effectively, may lead to financial freedom in the long run. Dividend growth investing is a long game, and it's a sluggish and tedious way to accumulate money. However, it is a method that has helped people like Warren Buffett grow their fortunes. Do you remember the time when you used to make snowballs as a kid? What happened to a small snowball when you pushed it down a hill? Well, it increased in size, right? During its descent down the slope, the snowball thickens. With each spin, it packs in additional snow as it becomes larger. Compounding is shown by the snowball effect. It demonstrates how little acts taken over time may have an enormous impact. Investing in high-quality dividend growth stocks, on the other hand, may yield vast sums of dividend income over time. The Dividend Aristocrats, a group of 65 firms in the S&P 500 with 25-plus years of dividend growth, are a good choice for investors seeking the finest dividend growth stocks. If all of this sounds a little too technical, let us give you an example using numbers. Consider a $1 investment that grew at a rate of 1% every day. Your $1 would have grown to approximately $77 million in 5 years. By the 7th year, you would be the wealthiest person on the planet. Such is the power of dividend reinvesting. But don't be misled by these numbers. Dividend investing takes its fair share of time before you actually do start seeing any real profits. Now, you must have understood that to make the dividend snowball move faster, you need to buy additional shares. One way to do that is using automated reinvestment or manually purchasing the shares. There are strong viewpoints on automatic reinvestment versus cash dividends in the DIY investing community. Some individuals like to keep an eye on the stock price in order to discover the greatest deal. Is there a better investment out there? This may be true, but keep in mind that if you make manual purchases rather than having your money automatically reinvested, you may have to pay a trade commission. Alternatively, you may require sufficient funds to purchase a whole share rather than just half a portion. You may construct your portfolio with a collection of partial shares using a snowball method while automatically reinvesting dividends. A common mistake that many people make is that they do not do their homework, and as a result, they are unable to understand the whole picture. In the case of partial shares, you need to have an idea about the amount you are getting back. Everything looks great until you realize that you're only receiving a tenth of a cent share of the stock, which means it might take you decades to reach one full share. If you need to transfer your investments across brokerage firms, such partial shares will be sold because only whole shares are transferred. You're not just back to square one with that holding, but you've also got more paperwork to deal with for the next tax year. Calculate how many shares you'll need to attain a minimum of 1/4 of a share every year for any firm you're considering investing in. It may not come out precisely as predicted due to price volatility, but it'll get you near enough to help you make meaningful progress on building your assets. Depending on the dividend yield of the company, you may be surprised at how much money you'll need to invest. Start where you can, and if the value appears excellent, you can purchase more shares later when you have more money. Many successful investors have done this. To increase your chances of a successful buy and hold dividend snowball approach, buy shares from well-established firms with a track record of paying and increasing dividends. While previous success isn't a guarantee of future results, firms like the Dividend Kings that have been paying dividends for at least 50 years are a quote-unquote safer option. In the stock market, especially, you do the best you can with the facts you have at the moment. Another thing to keep in mind is that dividends will be subject to taxation. Dividend income, including money reinvested in non-retirement accounts, is subject to income taxation. For additional details on what taxes you'll owe, see an experienced tax expert. Make sure you don't get caught off guard during tax season. You should also consider the kind of businesses you invest in. Some corporations' payouts will be classified as qualified dividends, which are taxed at a lower rate than ordinary dividends. Qualified dividends are generally paid from blue chip firms, and there are restrictions on how long you may keep the stock. Ordinary dividends are frequently paid by real estate investment trust (REIT) businesses or shares that have been held for a short period of time. However, this should not deter you from investing in one sort of stock over another. You want to make sure that your purchasing selections are well informed. Now let us give you a real-time scenario of the snowball effect in action. Lowe's is the country's second largest home improvement retailer, after only the Home Depot. Lowe's was one of the country's largest home improvement retailers in 1990. Even back then, it had a dividend history of nearly 25 years of rises. Lowe's finished the year with an adjusted price of $118.37. Lowe's stock achieved compound annual returns of 27% each year over the previous 30 years, with an adjusted price of 0.9 cents at the end of 1989, accounting for things like stock splits and reinvested dividends. This indicates that a $1,000 investment made 30 years ago would be worth slightly more than $1.3 million in 2020. I hope your family was one of the low-back investors at the time. With enough patience, you may build a dividend snowball that will pay your bills and eventually replace your daily income. Have you considered incorporating dividend snowballing investing into your wealth-building strategy? Or have you made the decision that this snowball tactic isn't for you? If it is the latter, then we recommend that you guys should reconsider your options. You never know, you might end up becoming the Warren Buffett of your generation. In the end, all we would like to say is that stop focusing on buying low and selling high. Focus on buying, but always remember to do your research before you invest in anything. The reason we love this approach is that it is a passive source of income. All the work has to be done in the beginning, and even then, you just have to gauge the health of the company. After that, you can let your money do all the work for you. So that is all the time that we have today, folks. I hope you enjoyed this video. Please do remember to like it and remember to subscribe to our channel and also hit that bell icon on your way out. See you all next time, folks.